Hi everyone, I'm Dr. Priya from Faculty of Management, SRM Institute of Science and Technology, Ramapuram, Chennai. In this video, we will learn about algorithmic trading. If you take the case of a trader, the main objective for a trader is to earn profit. And the trading system has evolved a lot in the recent years. Earlier, we have used outright system, and this outright system has been replaced with electronic trading, and this electronic trading has been replaced with algorithmic trading these days because of the evolution of artificial intelligence and machine learning models. Let's define what is algorithmic trading. I think everyone knew about algorithm. Algorithm is a set of instructions. Coming to the part of this algorithmic trading, it uses a computer program that follows a defined set of instructions to place an order. The order can be a buy order or a sell order. And this set of instructions mainly focuses on timing, price, quantity, or any mathematical model. If you take the case of a human trader, why we have moved from a human trader into the algorithmic trading, the main purpose or the reason behind this is this human trader this trading. Okay, the, there are lots of emotions and psychological factors that affect the trading activities. When we are moving into this algorithmic trading, then all these emotions and psychological attitudes or psychological behaviors, everything can be ignored. And there is a strategic trade-off where we will see both the advantages and disadvantages of algorithmic trading. Um, through this algorithmic trading, trades are often executed at the best possible prices. And what is the latency level in this algorithmic trading is it is very less, and it also reduces the transaction cost. And simultaneously, automated trades on multiple market conditions can be done in the case of the algorithmic trading. And there is no human error, so which can reduce manual errors a lot. And all these algorithmic trading could be tested with the help of the historical and real-time data to see whether it is viable for trading strategies. And if you take the case of disadvantages of this algorithmic trading, it has a latency where the trading has to happen to a greater speed. This fast execution has to be done. If there is any delay in execution of a trade, obviously it will result in missed opportunities and it can incur a huge losses to the traders. And if there is any swan events, this algorithm cannot deduct the blank swan events, which can also result in losses for the algorithmic traders. And this highly relies on technology, including computer program and high-speed internet connections. If there is any technical glitches, it can also disrupt the trading process and result in losses. And all these algorithmic trading are being regulated by various regulatory bodies. In India, it has been regulated by SEBI. And it also involves high capital cost and there is a chances of limited customization. And the main disadvantages of this algorithmic trading is lack of human judgments. Okay, so we cannot account for any qualitative or subjective factors that influence the markets. And how this algorithm thinks, I will be explaining this concept with the help of an example. You can just see this chart and you can see the stock price movements. And we have an 50-day moving averages and 200-day moving averages, which are the most commonly used technical indicators when we are doing this technical analysis. So the algorithm, when we are writing the algorithm, so I have used the moving average as a technical indicators, and I have decided like the most commonly used strategy in algorithmic trading is the moving average. So here we will see, yeah, we can see blue line which indicates the 50-day moving averages and an yellow line which shows 200-day moving averages. If the 50-day moving average is above or is crossing the 200-day moving average, which indicates a buy signal. And if the 50-day moving averages lies below 200 moving average. It indicates a sell signal. This is the concept which we have framed for this moving average strategy. So by a sell signal based on the moving averages. And how does this execute? How does this algorithm is being executed in the system? Okay. So the most commonly used method is high frequency trading. If human is able to place an order, it takes nearly 250 million seconds to decide for executing an order, whether it can be a buy or a sell. But if you take in the case of high frequency trading, it has been reduced to nanoseconds. Within a nanoseconds, that is billionth of 1/billionth of second, we were able to make a order or is it place an order. And who are the users of this algorithmic trading? It is mainly large investors. Large investors like financial institutions and NBFCs, pension funds, mutual funds, and insurance companies. They are the one who were using this algorithmic trading for quite a period of time. And short-term traders and sell-side participants like brokerage houses, speculators, arbitragers, um, they are also getting benefit because of this automated trade executions. And now this has been widely used by the retail investors also and the systematic traders, trend followers, hedge funds, or as pad traders are also involved in this algorithmic trades and mainly for buying of futures and options, EPTs, ETFs, and all these things. And let me just brief about how does this algorithmic trading works. First thing is the trader needs to decide on these strategies, or else they need to frame the hypothesis. In the previous slide, we have seen an example with a moving average. We have used a moving average as a technical indicators like 50-day moving average and 200-day moving averages. And then we have seen the concept behind this is if 50-day moving averages crosses 200, it is a buy. If it is like below 50-day moving average is below 200, it indicates a signal. So this is the concept or the strategy. First, you need to frame the hypothesis, and then you have to write a program for this. Then in earlier days, all these programs has been written in C or C++, which is quite complicated these days as we are dealing with large volumes of data and the speed of execution should be very fast. So it has been replaced with impact programming, where in the library files are there, where you can use the library files and you can develop the algorithm. So there are empty number of strategies out there. So we have to, as a trader, we have to decide on which strategy we are going to adopt and write a program. And once the algorithm has been written, all these will be in the form of API files. And this has to be executed in a virtual platform. And in the virtual platform, we have to check whether is it working or not. We have to do testing. And we have to, after finding out if there is any errors, we need to rectify it. And then we have to check the profit level. And then we can, if everything has been validated, if there is any optimization issue, we complete all the process and then you can link it with the microsystems. This is the process of limit trading. And what are the common strategies? Most of the input traders policy these days is trend following. Yeah, that's what I have explained here. Either using 200 day or else 50-day moving average to generate buoyant signals. And next one is the mean reversals. Basic idea behind this reversal is we have like high impulses and low impulses. And all these high impulses and impulses and the low pulses has to be converged or is it has to be converged to average value over a period of time. This price range, an algorithm which defines this price range mathematically trades when the price breaks in or out of that range. Next one is we can do the another strategy is the momentum trade. This momentum trading capitalizes the continuation of existing price trends and identifying assets with is there any strong price momentum that happens in the trend. And an algorithm enters a position in the direction of a strong if it identifies whether it is a bullish market or is a bearish market, and according to the uh, bullish and bearish, the trades will be placed. And then the other one is the trading strategy. In the case of arbitrage trading strategy, the profit is earned based upon the differences in prices in different markets. So the statistical example is, okay, you can use any quantitative models to identify historically correlated assets and that are temporarily mispriced. You can buy in one market and then you can sell in the other market and earn the profit based upon the difference in prices. And this one is pair trading. In case of pair trading, you have to choose two stocks or is two highly correlated stocks. Okay. So it is a neutral strategy. Two highly correlated assets has to be chosen from the same sector. And in this algorithm, where you have to take both long position as well as the short position. The long position in the underperforming asset, and then the other asset and the short position which outperforms. And then next one is the index fund rebalancing. The index funds must be periodically rebalanced based on their holdings. If an trader is a holding, they have to keep revising their holdings based on the returns or as the profit the index funds. Okay. So we have to correlate the index with the trader holding. That is your index fund rebalancing, where the algorithmic trades capitalize on the expected trades and they always focus on the yield for small as well as a consistent profit. Usually, the range of this profit will be between 20 and 80 basis points. And then the other strategies are the volume weighted average price and then time weighted average price. In both these strategies, what we do is we need to break up a large order and release them dynamically determined in smaller chunks of the order to the market using stock-specific historical volume price. And the main aim is to execute the order close to the volume weighted average price. Whereas in the case of the time weighted average price strategy, the larger order has to be broken down into smaller chunks of the order to the market by evenly dividing the time slots between start and the end time. The aim is to execute here is to execute the order close to the average price between the start and the end time so that we can minimize the market impact. And the next one is your implementation shortfall. This strategy is of minimizing the execution cost of an order, where we can trade on the real-time market that is saving on the cost of the market. This strategy will increase the target participation rate when the stock prices move favorably, and you can see an increase it when the stock price moves like this. So these are some of the strategies in algorithmic trading. And one of the core requirements for this algorithmic trading is the trader needs to know basics in programming knowledge. And apart from this programming knowledge, the trader needs to know both fundamental analysis and technical analysis part also. It is not like anyone can enter into this algorithmic trading. It is absolutely false. A person needs to have a basic knowledge of it. Fundamental analysis and technical analysis will be sufficient to enter into this algorithmic trading. And then we require high speed connectivity because the computer places the orders. So if there is any network issue, which can lead to huge losses to the traders, and the trader has to be linked to the inform as well as it has to be linked to the real-time market data that feeds that the algorithm needs to keep monitoring for the opportunities. The algorithm will keep monitoring the price fluctuations And then all these algorithms has to be back tested. Only if it is back tested and we have to check the validation. Only after validation, it has to be linked to the blockchain services. And the SEBI has come up with lots and lots of new regulations regarding this algorithmic trading, particularly with respect to the retail investors. In August 2025, the SEBI has introduced the guidelines to the algorithmic retail traders, especially. There are some rules, like they have to be mandatory exchange approval. The brokers needs to get approval from SEBI for this algorithmic strategy. Whatever strategy we are going to execute has to be approved by the stock exchange before deployment. And no unapproved algorithm can enter into the live markets. And each algorithm has an algo ID tracking that has to be, that unique ID has to be linked to the services algorithm. And under algorithm ID tracking, we have like there is an option like the algorithm can be disclosed to the other users also. And there are cases where algorithm cannot be disclosed to the other users. So accordingly, the trader needs to get approval from the exchanges. And the broker is fully responsible for approving the client strategies. So we have a number of broking firms. So they have to approve the uh, what type of strategies the clients are going to use. And we have to use the switches. Okay, so all brokers and platforms must have an emergency stop mechanism. Okay, so if there is any malfunctioning that is happening in the algorithm, either it can be because of virus or of any technical glitches, there should be some switches where we need to stop the algorithm so that we can prevent it from disrupting the financial markets. And all open APIs are banned in the new SEBI rules. So no more open APIs that can be traded in the platforms. So algorithm must be hosted and deployed only through the broker-owned infrastructure. So open APIs are completely banned as per the new SEBI rules. And all the platforms and the users must use two-factor authentication and authorization to prevent unauthorized access and the API or usages. And if you take the case of what are the future takeaways of this automated trading is power and precision. So algo trading is a fundamental shift where we are just replacing the human emotions with machine logic for unparalleled speed and accuracy and efficiency in execution, where monotonous orders are being replaced with AI of algorithmic trading. And this algorithmic trading also carries some inherent risks for technical failures and reliance, and it completely relies on the historical data. And we have a diverse toolkit ranging from various strategies. And then next one is the future is well defined by two parallel trends. There's one is technology as well as we have a robust regulatory framework which ensures stability and fairness in this trading, in this algorithmic trading. Thank you.